Is real estate the yellow brick road in retirement? You're probably thinking, I already own a house, so it'll be easy. I'll just add more real estate investments to my portfolio. No, it's not that simple. Unlike Dorothy, you don't just dance down the yellow brick road. You actually have to build that road before you can follow it. And it's not always straightforward or easy, because when it comes to real estate, more doors, more chores. Hi, I'm Demetriades. While real estate can generate a great income stream in retirement, it's also a commitment that deserves a closer look before jumping in. Today, we're exploring the potential benefits like income and inflation protection, and the risks and challenges, including the time, money, and flexibility that real estate demands. Let's start by looking at why real estate often holds a strong appeal for investors. During inflationary periods, the cost of living rises, and investments that don't keep up with inflation lose their purchasing power. Real estate, however, has a strong track record of resilience against inflation. So unlike fixed income investments like bonds, it has the potential to keep pace with the rising cost of living. As prices rise, so do property values and rental income, helping property owners maintain their purchasing power over time. There's also the prospect of passive investment. And who doesn't dream of earning without constant work? Rental properties have the potential to provide a steady stream of cash flow, which is especially attractive for retirees. Once the property's rented, the income can be pretty consistent, letting you supplement your retirement savings without depleting your other investments. There's a key metric to consider when you're looking at investing in rental properties. Rental yield measures the income a property generates relative to its purchase price. It's usually expressed as a percentage, and it's calculated by dividing the annual rental income by the property's purchase price, and then multiplying by 100. For example, let's say you buy a property for $300,000. That generates $15,000 in annual rental income. Using our equation, your rental yield would be 5%. A 5% rental yield means you're making back 5% of your property investment in rental income each year before considering expenses. The higher the rental yield, the stronger the cash flow, which could make it easier to cover costs and/or generate surplus income. 4 to 6% is generally considered a moderate or typical yield. Properties in this range tend to be in stable, desirable areas, which could mean lower vacancy rates and potentially less hassle with management. This range is attractive for retirees because it can cover expenses while providing some passive income without excessive risk. 7 to 10% is considered high rental yield and is usually found in markets where property prices are lower, but rental demand is solid. While a higher yield sounds appealing for income purposes, properties in this range might be in less stable markets, requiring more active management or higher maintenance costs. For retirees, a 7 to 10% yield might work well if you're comfortable managing property demands yourself, or you can hire a property manager. Below 4% is considered low yield, so you should think about whether or not property values might appreciate significantly over time, like in prime city locations. If the answer is yes, the property might still be worth considering. But keep in mind that low yields may not generate enough income right now to make most of your investment or even cover expenses. Low yield may not be a deal breaker, but those properties are less ideal if you're looking for a steady cash flow in retirement. Please also note that we're talking about gross figures. Basic rental yield doesn't account for costs like property management fees, maintenance, taxes, or vacancies. To get a more realistic picture, you also need to calculate net yield, which factors in expenses and shows your actual cash flow. These expenses can vary significantly, so be sure to include them in your calculations. Another key appeal of real estate is appreciation, the potential for your property's value to grow over time. Historically, property values tend to increase, especially in desirable areas or growing markets. This means that on top of earning rental income, you may also see your property's overall value go up, which increases your total return on that property. And there's another layer to appreciation, tax savings. In the U.S., homeowners who sell their primary residence at a profit may qualify for capital gains tax exemptions. Real estate investors can also use a 1031 exchange to defer taxes on a property sale if they reinvest the proceeds in a similar property. For retirees, that means that with the right strategy, you might enjoy both long-term appreciation and some tax benefits today. Finally, real estate is a tangible asset you can see and touch, making it easy to grasp both literally and figuratively. It can help diversify your investment portfolio and balance risk. And its low correlation with the stock market means its value doesn't necessarily rise and fall with stock prices. So we've covered why real estate has such strong appeal, income potential, inflation protection, and the chance to diversify. But I also want to touch on some realities that might make real estate a challenging commitment, particularly in retirement. First, let's talk about actual property management. The real estate yellow brick road may look effortless, but managing properties can be anything but passive. Placing those bricks takes effort. You're responsible for everything: finding tenants, collecting rents, arranging repairs, and even dealing with legal issues if they arise. And let's face it, things do come up. Pipes burst, appliances need replacement, and sometimes tenants don't pay on time. Turnover is also part of the deal, which means periodically re-renting the property. Remember, more doors, more chores. You can always hire a property management company to handle these tasks and make things easier. But keep in mind, management fees often range from 8 to 12% of the monthly rental income. This cuts into your returns, and even with a management company, you're still responsible for big decisions, unexpected repairs, and vacancy periods. Real estate is only passive if everything goes smoothly. And let's be honest, that's rarely the case. Next, let's consider the costs. Real estate is a capital-intensive investment. Unlike stocks and bonds, which you can purchase in small increments, real estate generally requires significant upfront capital. You're looking at down payments, closing costs, property taxes, insurance, and ongoing maintenance. If you're financing the purchase, you'll need to factor in mortgage payments and interest. Also, real estate isn't easily diversified. To diversify effectively, you need multiple properties in different zip codes or even different types, like residential and commercial, which requires even more capital. So unless you're prepared to handle these costs over the long term, real estate could drain more resources than it generates. And then there's the issue of liquidity. Real estate isn't like stock or bonds, which you can sell with a click. Property sales can take months, especially in a slow market. And if you need to sell quickly, you might have to accept a lower price. High transaction costs, including agent commissions and closing fees, also affect your returns when you sell. I talk frequently about how financial flexibility in retirement is critical. You might need quick access to funds for unexpected expenses, healthcare, or lifestyle changes. So you should be aware that with real estate, that flexibility just isn't there. Those bricks you lay might be sturdy, but they're not always easy to move if your plans change unexpectedly. Finally, let's talk about market volatility and selling risk. While property values generally do rise over time, real estate markets are highly regional and can fluctuate pretty dramatically. What's happening in one city can be completely different from the next, and it's not uncommon to see local markets decline. So even though your property may look valuable on paper, you might not get what you expect when you sell if the market takes a dip. Timing is another major factor. Real estate isn't a guaranteed win, and the market can pivot faster than you'd expect. If you're forced to sell during a downturn, you could take significant losses. And unlike other investments, you can't always wait it out if you rely on the property for income or need the funds. So is real estate a good investment for retirement? The answer isn't simple. It's a clear yes and no. Let me put it this way. Real estate can be a valuable part of a retirement portfolio, but it's no lightning in a bottle. Like any asset, it has advantages and drawbacks, and you need to weigh them against your personal goals, your risk tolerance, and your lifestyle. On one hand, the tangible benefits of real estate are hard to ignore. Owning property can offer you cash flow potential, tax benefits, the chance for appreciation, and the security of a physical asset. But on the other hand, it can be a high maintenance investment with costs, risks, and a commitment level that's often underestimated. More doors, more chores. Real estate isn't always something you can easily cash out if plans change, and it comes with the responsibility of active management, whether you hire someone or you do it yourself. So maybe there's a place in your portfolio for real estate investments, but the real question is, how does that look for you? Real estate might be a worthwhile addition to your retirement strategy if you're prepared to do the proper due diligence, thrive on managing details, enjoy the challenge of property upkeep, and have the capital to handle the long-term commitment. If you're prepared to treat real estate as a business, it could offer you a mix of cash flow and appreciation potential that aligns well with an active approach to retirement investing. And there's something to be said for the rewarding, hands-on aspect. But it's important to go in with clear eyes about the time and energy required. If you're looking for truly passive, flexible, and simple investments, real estate might feel like a lot more work than it's worth. This is especially true if your ideal retirement involves freedom from day-to-day responsibilities. Real estate can sometimes require constant oversight and the ability to make financial decisions quickly, particularly when unexpected issues arise. For some, the commitment to property management can feel like a job, even with a property manager. More doors, more chores. It's also essential to consider how much of your capital you're willing to tie up in a relatively illiquid asset. If having easy access to funds is important to you, whether for travel, family, or unexpected expenses, real estate may not provide the flexibility you need. Selling a property can take time, and market conditions might force you to wait longer or accept a lower return than expected. The truth is that real estate can be a great tool for generating income and increasing wealth in retirement. But like any tool, it has its specific uses. Does including real estate in your portfolio let you follow your path? You make the decision. To quote the great and powerful Oz, all you need is confidence in yourself. Confidence in yourself and your plans puts you on the right road to your retirement. I'm Keith Demetriades. If this conversation has sparked your interest, please like, share, and subscribe to stay connected for more insights on building a retirement strategy that works for you. Be a savvy steward. Make your life count.